In this video, I'll go over everything you need to know about personal loans, and we're starting right now. Hey guys, Elliot here. So when it comes to individual non-business loans, most people know about the three big ones. The first is a mortgage to buy a home, the second is a student loan for educational expenses, and the third is an auto loan to get your car or truck. There is, however, another major class of loans that are often overlooked, and that is a personal loan. These types of loans don't carry a special designation indicating what they are for, and in theory they can be used for anything. However, in reality, personal loans are most often used to pay off high-interest debt or consolidate debt into a single payment. Personal loans are risky to a lender. After all, they're almost always unsecured and there's no home or vehicle to repossess in case of default. For that reason, they are very much credit-based, and the better your credit score and history of paying back debt is, the better you'll be in terms of getting approved and getting a good rate. The first step in getting a personal loan is the application. You apply with a bank, credit union, or an online lender. You'll need to provide your social security number, bank statements, pay stubs, and whatever other verifying documents the lender asks for. The next step is the approval. The lender will review your application and credit report to determine your eligibility and loan terms. This will include all the typical items such as your credit score, debt to income ratio, employment history, and current and projected income. If approved, you'll receive the full amount of the loan in a lump sum sent to your checking account, usually within a few days and with a grace period of a month before your first repayment is due. The repayment is very straightforward. You'll make fixed monthly payments until the loan is paid off, with a period being anywhere from 1 to 5 years. You'll usually be charged a fixed interest rate, but some lenders offer variable interest rate loans as well. They may be a good idea if you're offered a low introductory rate for, let's say, the first 2 years of a 5-year loan and you expect to pay back the loan early before the introductory period expires. In general, though, a fixed rate is better for most people. Personal loans may charge you fees such as an origination and admin fee. You will also likely be charged if you make late payments and sometimes if you pay off your loan early. So be sure to bring up all of these during the application process and go with a lender that is willing to minimize or eliminate these extra costs to earn your business. The best lenders out there will not charge an upfront origination fee or an early payoff fee. In general, look for lenders that have a fast and streamlined application process, give you a discount for autopay, don't charge junk fees, and have good customer support. How much should you borrow when it comes to personal loans? Well, this should be completely dictated by what you are planning to do with the money. If the loan is to consolidate high-interest debt, borrow just enough to pay it off and not a penny more. Most personal loan programs lend a minimum of $1,000 all the way up to $100,000, so if you have a sizable window as far as the amount. Now, I mentioned earlier that most people use a personal loan for debt consolidation, but what else can it be used for? Here's a survey from 2023 that lists out all the other reasons. The top 5 include debt consolidation, home improvement costs, large purchases, medical debt, and relocation expenses. Interestingly, the next 2 reasons include paying for a vacation or a wedding, and generally this is a bad idea as these are not unforeseen events and you should save up for such expenditures, not take out a loan. Okay, that was a quick explanation of personal loans. As always, if you enjoyed this content, please do like and subscribe, and I will see you in the next video.